An RRSP is a registered retirement savings account. A beneficiary form on file at your bank determines who gets the balance when you die. Most people fill it out once at account opening and never think about it again. Your RRSP was supposed to pass your savings to your family. For Canadians who leave that beneficiary field blank, or who filled it in once and never updated it after a life change, it can do the opposite. On a $200,000 plan, stacked on top of $90,000 in other income, the tax on the terminal return, the final income tax return filed for the year you die, can land close to $100,000. That is the number at Ontario rates on that specific income mix. Your province and your other income will shift the figure, but the shape of the problem is the same everywhere. I will come back to what qualifying survivor actually means, because it is narrower than most people assume, and there is a Quebec distinction that changes the entire path. I will flag it where it matters most. The roadmap is short. First, what the CRA actually does to an RRSP the moment the holder dies, because the mechanic surprises almost everyone. Then the survivor rollover that shuts that tax bill down, and the 3 conditions it depends on. The third piece, the 3 ways that rollover quietly breaks, is the part most families discover too late. And last, the one step you can take today to make sure your form actually does what you think it does. The CRA treats your RRSP as if you cashed it out the day you died. That is called a deemed disposition. The full fair market value of the account, every dollar, is treated as income on your terminal return. The terminal return is the final income tax return filed on behalf of the deceased for the year of death, covering income from January 1st through the date they passed, with the deemed RRSP amount landing on top. These are the 2 concepts the rest of this depends on. Deemed disposition. The CRA deems you to have received the full account value, even though no cash actually moved. Terminal return. The final tax return for the year of death. It includes all regular income for that year, plus the deemed RRSP disposition on top of it. Here is what that looks like in practice. Someone passes away during the year with $90,000 in regular income from pensions and other sources, and a $200,000 RRSP. The terminal return stacks those together. That is $290,000 of income landing on one return in 1 year, taxed at the highest marginal rates on the way up. In Ontario, the top combined federal-provincial rate runs around 50%. On that stacked return, the tax on just the upper portion, the RRSP dollars sitting in the top bracket, can land close to $100,000. That is the default. That is what happens when nothing intervenes. One note before moving on. If you have already converted your RRSP to an RRIF, a registered retirement income fund, there is a mechanism called a successor annuitant that lets a spouse step directly into the plan and continue the payments with no deemed disposition. The RRSP has no equivalent to that. The RRSP path runs through the beneficiary designation, and that is what we are focused on here. Now, the CRA does provide one escape from that terminal tax. The escape is called a qualifying survivor rollover. To understand how it works, you first need to understand what a refund of premiums is. That is the CRA's term for the RRSP proceeds paid to an eligible beneficiary after the annuitant's death. If the conditions are met, those proceeds can move into the survivor's own registered account, and the tax is deferred rather than landing on the terminal return. 3 conditions have to line up. First, the person receiving the RRSP must be a qualifying survivor. That means a surviving spouse or common law partner, or a financially dependent child or grandchild. Financially dependent, in this context, generally means someone who relied on the deceased for financial support due to a physical or mental impairment. There is also a narrower path for a financially dependent minor without an impairment, but the rollover treatment in that case is more limited, typically into an annuity to age 18. An adult independent child who is financially self-sufficient does not qualify. Second, The beneficiary has to elect to treat the amount as a refund of premiums on their own income tax return for the year of receipt. That election is what converts the payout from ordinary income to a rollover eligible transfer. Third, they have to actually transfer the proceeds into their own RRSP, RRIF, or eligible annuity, not take the cash. The transfer has to happen within the year of receipt or within 60 days after the end of that year. Miss that window, and the rollover is gone. The rule is elect and transfer. Taking the cash means the full amount lands on the survivor's return as income, taxed at their marginal rates. One thing to be clear about, this rollover defers the tax. It does not erase it. The spouse holds that $200,000 in their own registered account, and tax is owed when they eventually draw it down. What the rollover prevents is the entire bill landing at once at the top rate on the year you die. For cases where the RRSP proceeds go through the estate, rather than directly to a named beneficiary on the plan contract, there is a form called T-2019. It allows a qualifying survivor to still claim the rollover through the estate path, but only if they complete the transfer within that same window, the year of receipt or 60 days after. Now, the 3 ways that path quietly closes. 3 failure modes. Any one of them costs the estate the rollover. Failure mode 1. The beneficiary field is blank. It happens more often than it should. You open an RRSP at 28, you do not fill in a name, and you never go back. When you die, the proceeds fall into the estate. The terminal tax hits without the rollover, even if you had a qualifying spouse who could have used it. Failure mode 2. The named beneficiary predeceased you, and the form was never updated. This happens most often after the death of a spouse earlier in the marriage. The plan contract still has the old name on it. The institution finds no living beneficiary and routes the proceeds to the estate. Same outcome as a blank field. Failure mode 3. The beneficiary is an adult, non-dependent child. This one is the most common misunderstanding. The adult child receives the cash, but the income is taxed on the terminal return of the deceased parent. The estate pays the tax. The child has the money. If the estate does not have liquid assets to cover that bill, it may need to sell other assets, or have a very difficult conversation with the child about returning some of it. Now, the Quebec distinction I flagged at the start. In Quebec, if your RRSP is held at a bank or brokerage, a beneficiary designation on the plan contract is generally not valid under Quebec civil law. The designation needs to be in your will or in a notarial codicil. The exception is an RRSP held through a life insurance company, a segregated fund account. Those are governed by Quebec's Insurance Act, not the Civil Code, and the plan contract designation stands. Talk to your institution first to confirm which rules apply to your account, and a notary if you are unsure. And back to qualifying survivor. The rollover works for a spouse or common law partner, or for a financially dependent child or grandchild with an impairment, or a minor with financial dependency on the deceased. An adult child with a job does not qualify, regardless of how close the relationship. The form has to name someone who meets the CRA's definition, not the family's. The fix is straightforward. The execution is the part most people never get around to. Call every institution where you hold an RRSP and ask for the beneficiary designation on file, not the dashboard summary, the actual plan contract form. Ask who is named and confirm it is a living person who qualifies under the CRA's definition, a surviving spouse or common law partner, a financially dependent child if that applies to your situation. Then run the life events check, marriage, divorce, the death of anyone previously named on the form, the birth of a child you want to include. The plan contract does not update automatically when your life changes. You have to go back to the institution and do it manually. One important clarification. In most provinces, the beneficiary designation on the plan contract is legally separate from your will. A general clause in a will does not override an RRSP plan form designation. However, A will clause that specifically names this account can take priority over an older plan form designation in some provinces. Keep both documents aligned. The plan form generally governs the registered account in most common law provinces. In Quebec, the will governs. Know which one applies to you. The friction most people run into is that the beneficiary form lives separately at every institution. 3 old RRSP accounts at 3 different banks means 3 different forms, 3 different phone numbers, 3 different processes. WealthSimple Invest keeps all your registered accounts in one place, with the beneficiary designation part of the account setup and visible from one dashboard. One session instead of 3 separate calls. There is a referral link in the description. $25 for you when you fund an account. I earn a referral commission on the same scale. Check the description for current tiers and terms. Any bank or brokerage in Canada allows you to set a beneficiary designation on a registered account. The lever is making the time to actually check it. WealthSimple is one way to reduce that friction. It is not the only way. The cost of not doing this is not subtle. It is the difference between a clean transfer and a tax bill in the range of $100,000 on an estate like this one. That is not a planning edge case. That is the default outcome when the form is wrong. This math runs through the CRA's own materials. If working through it gave you a clearer picture of what is at stake, the like button is how this reaches the next Canadian who needs to see it before the form does. If this video kept the wrong name off that form before it cost your family everything, every video on this channel runs on the same idea. Subscribe and the next estate or RRSP piece will find you first, before you act on any of this. Remember, I do not know your numbers. A professional who does might see it differently. Get a second set of eyes first. Thanks for watching. And if you want to go deeper on what your RRSP costs you during your lifetime, not at death, but year over year, the next video walks the withdrawal strategy that catches most Canadians off guard. The link is on screen now.